Hi there, welcome to Kneppy Invest. In today's video, I'm going to be featuring Super Retail Group, focusing on the company's financial year 22 results. And then I'm going to look to see if there's any value in this company right now, if I think this is a high quality company, or if the share price is in an uptrend or downtrend, if I think this is a low quality company. And to be honest with you, I've yet to decide whether Super Retail Group is a high or low quality company. I've got arguments leading me both ways. Now, for those who don't know, Super Retail Group is a company that owns 4 brands or retail brands, including Rebel, Super Cheap Auto, MacPack, and BCF. By far the best performing company in terms of revenue growth is MacPack, but that is the smallest brand. The largest 2 brands are Rebel and Super Cheap Auto. So my big question when it comes to this company is the quality. Is this a high quality company or is it a low quality company? Because the way I treat high quality companies is a little bit different than low quality companies. Now, if I thought Super Retail Group was a high quality company, it all comes back to value. And when I actually do look at the value, I am possibly seeing some value in this company right now. But if I consider this company to be low quality company, and then I look at the chart, because for low quality companies, it's all about the trend in the share price and underlying sentiment. If I take a look at the chart right now, I would not be induced at this point in time to take a position in this company. So whether I think this is a high quality company or low quality company is quite important, because I think there might be value, but the share price is in a downtrend. For full disclosure purposes, I am not a shareholder of this company at this point in time. I was a shareholder of Super Retail Group quite a few years ago. And one of the main reasons I did sell out was because I thought the company was a little bit overvalued for a retail company. I think the PE ratio might have been in the 30s at the time. Now, you could argue, because I took valuation in consideration when I sold out this company, that means I would consider Super Retail Group to be a high quality company. And that is an absolute valued argument. But another argument you could sway me on in defending whether this is a low quality company is just by looking at the chart here. So this is the long-term chart going all the way back to 2011. So 11-year chart. And when you do look at the share price over this 11-year period, particularly from about 2013 to now, the share price has done absolutely nothing. Now, what you could argue is that over the past 9 years, what this company has experienced is multiple compression or multiple contraction. And we'll have a look at the PE ratio for this company over the past 10 years later in this video. And that is actually a very solid argument. And if this company has gone through a period of multiple contraction or compression, that might turn around. And then if we see a period of multiple expansion and the PE ratio goes from less than 10 to say 20, that means this right now could be a period where Super Retail Group is attractively priced. Let's look at the financial year 22 results for Super Retail Group at a share price of $10.04. That was a share price at the end of trading on November the 4th. Now, the market cap of this company is roughly 2.3 billion, might be just a little bit less than that, but in that general ballpark. Now on to financial year 22 revenue, $3.5 billion. And the profit of this company for the financial year was 241 million. So if we compare the profit to the market cap, we can see the PE ratio for this company is actually less than 10. But I also like to focus on operating cash flow and even free cash flow to get a better understanding on how this company is performing. And if we focus on the operating cash flow, $124 million for the financial year. Now, the way I calculate operating cash flow is a little bit different than most people, simply because I do like to take into account leases. And that is really important for retail companies because they spend a lot of money on renting out their stores to sell their products. And that is an ongoing day-to-day business expense, in my opinion. So that belongs in the operating cash flow area. So when you do take into account the leases, the operating cash flows for Super Retail Group is 124 million. And what surprised me in regards to Super Retail Group is the amount of capital expenditure this company spent in the past year. And that equated to about $125 million, which means the free cash flow of this company is actually negative by only $1 million, but it's still negative. Now onto the revenue history for Super Retail Group going back 10 years. I've also included profit and operating margins in this particular slide. So the first thing I always look at for every single company is if a company has experienced revenue growth over the past 10 years. If it hasn't been the last 10 years, at least the last 5 years or even 3 years. And for Super Retail Group, this company has experienced some pretty good revenue growth over the past decade. In fact, revenue has more than doubled from 1.65 million to 1.65 billion to 3.55 billion. So it has been growing at a fairly consistent rate, and there hasn't been one year where revenue has been less than the previous year. So that's a fairly good tick in my book. Now, the other thing to take into consideration here is the profit, particularly in financial year 21 and even into financial year 22. We did see a surge in profit for many retail companies in financial year 21. For Super Retail Group, that surge was from 110 million in financial year 22, 301 million. Even if you go back to financial year 2019, before COVID-19, profit increased from 139 million to 301. So no doubt, the profit of $301 million in financial year 21 was a little bit exaggerated, a little bit higher than what you would have expected if we didn't have COVID-19. And even though we have seen a pullback in profit from financial year 21 to 22, decreasing from 301 million to 241 million, it is still significantly more than what we saw pre-COVID-19. So I think there is possibility of profit falling even further in financial year 23. So that means take the P ratio of Super Retail Group right now being less than 10 with a grain of salt. We might see profits fall even further in financial year 23. And I think the market is expecting that. And that is why a lot of retail companies look attractive if you just are looking at the P ratio right now. Now, looking at the revenue growth is fine, but you also got to take into account that some companies actually issue shares to make acquisitions or for other stuff, or just to increase their capital, that sort of thing. So I always like to look at the revenue growth per share. And if you do look at the revenue growth per share over the past 10 years, we have 5.3% per year. I would prefer that to be a little bit higher. And even if you look at the last 5 years and 3 years, we still get numbers are roughly around 5%. So fairly consistent growth in revenue per share over the past 10 years. So, and this is a slight red flag in my opinion, that even though there is revenue growth, the revenue growth per share is probably not quite as high as I would like. And probably the other thing to take into account is just the operating margins. And we have seen a significant increase in operating margins in financial year 21 and 22, increasing from 7.5% or roughly between 7 and 8% from the years 2017 to 2020, up to 13.6% in 2021, and then 11.1% in 2022. And I think there is a big chance that operating margins will fall in financial year 23. And even if we see some revenue growth for this company, we might see profits fall simply because of a decrease in operating margins. Now let's have a look at the cash flow statement for Super Retail Group. Now, after I look at receipts from customers, which for Super Retail Group was 3.9 billion in financial year 22, I like to focus on operating cash flow, 340.4 million in financial year 22. And remember, I take into account lease payments. I'll talk about that in a second. But we have seen a significant drop in operating cash flow from last year to this year, 600 million to 340.4 million. More than likely, that is because of an increase in inventories. We have seen a lot of companies on the ASX seeing their operating cash flow fall from last year because of spending in regards to increasing their inventories. So we'll see if that is true for Super Retail Group. Now, remember, I like to take into account leases. And for Super Retail Group, That was $216 million in financial year 22. So lease payments is a significant expense for this company because they are a retail company. And if you look at lease payments last year, that was 188 million. So this is an ongoing cost for this company. But before we get to lease payments, which is in financing activity section, if we look at investing activity section, payments of property, plant and equipment, and computer software, which is capital expenditure, totaled $125 million, which is a little bit higher than I would have expected for this type of company. So if we take into account capital expenditure, 125 million, lease principal payments, 216, that equals 341 million. Hence, this company was actually free cash flow negative, as I've already mentioned in the previous slide. So this company actually burned through a lot of cash in financial year 22 because I haven't even talked about dividends. This company provided $185 million of dividends to their shareholders. And if you take a look at their loans, so proceeds from loans, 483 million, repayment of loans, 483 million. So this company did increase their loans, which means this company burned through a lot of cash. And you can see that in the cash on hand at the end of the financial year. It actually decreased from 242 million at the start of the financial year to only $13 million at the end of the financial year. So this company doesn't have a lot of cash on hand, but it's okay because they have probably a lot of loan facilities that they can borrow to fund their day-to-day business. But probably the main thing moving forward is this company more than likely has increased their inventories, and they're going to work through those increasing inventories during the rest of financial year 23. And more than likely, that is how they're going to increase their cash on hand through selling of their products. Now, we could have looked at note 21, which was a reconciliation of the cash flows to profit, but the company did provide some useful information in their presentation. And in this particular slide, which was titled Group Cash Flow in their presentation, gave us all the information we needed to know about whether this company increased their inventory. They also gave us some useful information in regards to where they're spending their capital expenditure. But the main piece of information here was the third comment. Financial year 22 operating cash flow was lower due to increased net inventory investment and a $67 million tax payment related to prior year. Now, the other useful information is where they're spending their capital expenditure. So they mentioned here increased investment in store development program, including 21 new store openings and an extensive refurbished program. So they are spending a lot of money on capital expenditure on their stores. In fact, $22 million for Super Cheap Auto, $22 million for Rebel, $11.2 million for BCF, and $3.3 million for Macpac. One of the other interesting bits of information on this particular slide was the amount of cash outflow this company has experienced over the past 2 years. $229 million in financial year 22 and $42.7 million in financial year 21. So this is a slight negative in regards to this company, and I would like to see this company experience some cash inflow over the next few financial years because this would be a concerning sign. But I think this company would experience some cash inflows if they unwind the amount of inventory they now have on stock in their stores. One of the other things I like to do is just to see how the different brands of Super Retail Group are performing. And by far the biggest brands in this company are Super Cheap Auto with about $1.34 billion of sales in financial year 22. Then comes Rebel with 1.2 billion, BCF with 830 million, and coming up the rear, but growing the strongest, is Macpac with only $177 million of sales or revenue in the past year. But Macpac grew their sales at 15.3% in the financial year 22. If you do adjust the sales, because in financial year 22 there were 53 weeks, while in financial year 21 there's only 52 weeks. So if you adjust it because of that one extra week in financial year 22, Macpac still grew their sales at 11.4%. And in fact, the other three didn't grow their revenue all that much on an adjusted basis. Super Cheap Auto, only 0.5%. BCF 2.7%. In fact, Rebel went backwards by 0.6%. So looks like the majority of growth in this business in terms of sales is Macpac, but that is the smallest brand within this company. Now to the valuation metrics for Super Retail Group, and this would be a fairly important stage if you thought this company was a high quality company, because right now at a share price of about $10, the PE ratio for Super Retail Group, based off their financial year 22 numbers, is 9.5. Now that PE ratio is backward looking at the financial year 22 numbers. If you do expect, and I think there is a high likelihood, probability that the earnings per share will fall in financial year 23. So if you look at the forward-looking PE ratio, that more than likely will be a little bit higher than 9.5. So it might be 11 or 12, but still fairly low for this company, particularly if you look at the historical ranges of PE ratio. Price to sales ratio 0.66. Price to operating cash flow 18.5, which seems high, but again, I calculated the price to operating cash flow based off my operating cash flow calculations, which takes into account leases. If you don't take into account leases, the price to operating cash flow of Super Retail Group is actually a fair bit less than the P ratio. Now, I also did a reverse DCF based off the earnings per share, not the operating cash flow or free cash flow. And for this company to justify the current valuation, it has to grow at 2.6%, or the earnings per share have to grow at 2.6% per year. So even though I do expect earnings per share to fall in financial year 23, I would imagine that the earnings per share would return to a growth profile from financial year 24 onwards, unless we experience some really bad economic conditions. So even though I do expect earnings per share to be less or lower in financial year 23, I think a PE ratio right now about 9.5 is attractive, or is looking attractive for this company moving forward, particularly if you look from financial year 24 onwards. One thing I like to do for all companies is just compare the valuation metrics of the company, so PE ratio, price to operating cash flow, EV to free cash flow, whatever valuation metrics you do like to use. I like to compare that valuation metric now to historical levels. So we know the PE ratio of Super Retail Group is right now is below 10. But is that unusual or is that usual? So if we look at the 15-year history for Super Retail Group, it is unusual for the PE ratio of this company to fall below 10. And when it does fall below 10, there is usually some underlying macroeconomic issue like 2008, 2009, or some pandemic like the COVID-19 financial panic. Those are the two times when the PE ratio of this company has fallen below 10. So maybe this is an indication that we are moving or heading towards another recession around the world. The very fact that PE ratio of this company is now less than 10. So it doesn't stay below 10 for very long. In fact, during the COVID-19 financial panic, it stayed below 10 for about or less than 1 month. During the GFC, it stayed below 10 for about 9 to 12 months, but then recovered quite quickly as soon as we came out of the GFC. The company did provide a trading update at the AGM on 27th of October 2022. This is one of the reasons I really like to look at AGMs is because most of AGMs are done about 3 to 4 months after the end of the financial year. So a lot of companies and their management know how the company has been performing in those first 16 weeks of the financial year. And that is what Super Retail Group has provided here in their trading update. Like-for-like sales growth in the first 16 weeks of financial year 23 compared to financial year 22 and financial year 20. Now, be warned, there were some lockdowns in financial year 22. So even though group sales have increased 20%, that was comparing to a lockdown state. If you compare to financial year 20, sales have increased 30%. But there is some little bit of negative sentiment when you look at the commentary in this trading update, because they say or mention while current trading remains strong, so increasing 20% in the first 16 weeks of the financial year, the group expects higher mortgage rates and increased cost of living expenses will begin to impact consumer spending. And that is exactly what the Reserve Bank wants by increasing interest rates. They want us to be spending less. And if we don't spend less, if we continue to spend, then interest rates and inflation might keep going up. So that is exactly what Super Retail Group are saying here. Be a little bit wary that even though the company has increased their sales 20% in the first 16 weeks, that sort of bullishness might not continue for the rest of financial year 23 because of rising interest rates. Now onto the chart for Super Retail Group. If I thought this company was a low quality company, the most important thing moving forward would be the share price trend. Is it moving up? Is it moving down? Or is it going sideways? The valuation of the company would be secondary, less important. So if we take a look at Super Retail Group's daily chart going back to May 2021, you cannot say right now the share price is in an uptrend. At the very least, you probably could argue the share price has been going sideways, even though the share price has been quite volatile over the past 4 to 5 months. We have seen the share price rise from $8 at the low in June to a high of $11 in August, then pull back to about $8.60 towards the start of October or the end of September, and then has rallied again to about $10.50. But the share price is not in an uptrend right now. We did see a higher low in September or late September, early October, but we have not seen a higher high. I would like to see a higher high before we even think about the share price of this company moving into an uptrend. And if I thought this company was a low quality company, I want to see the share price in an uptrend before I even think about taking a position in this company. I plan to continue doing these financial year 22 result videos. In the next 5 companies I will be featuring include Objective, Sims Metal Management, Credit Corp Group, Steadfast, and Australian Clinical Labs. If you do have a suggestion, preferably a company that is profitable, that is growing, just leave that suggestion in the comment section of this video. That's all I have looking at Super Retail Group, focusing on their financial year 22 results. I'm yet undecided whether this company is high quality or low quality, and that is quite important because if I thought Super Retail Group was a high quality company right now, it is starting to look attractive with a P ratio of less than 10. Very rarely do we see the P ratio of this company less than 10. You might be seeing some value right now. And particularly if you were bullish about the future of this company, buying in now could be a good time to take a position, or if not now, maybe the next few months, particularly if we see the share price and the value of this company fall further from here. But if I thought this company was a low quality company, the share price trend would be more important than the valuation. And right now, the share price of this company is not in an uptrend. So I'd probably want to wait before the share price gets into an uptrend before I even think about taking a position in this company. If you have any thoughts about Super Retail Group, any questions, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.